Folks, if you want to understand money, whether it's your own or in a business, you have to know where to look. It's not about some secret formula or a get-rich-quick scheme, it's about reading the scoreboard. In business, that scoreboard is made up of 3 core financial reports: profit and loss statement, balance sheet, trial balance. These aren't just for accountants in stuffy offices, they are for you. They are the tools you need to make smart decisions. See what's working. And, more importantly, see what's broken before it breaks you. Think of it like this. Driving a car without a dashboard is a recipe for disaster. You wouldn't know your speed. You wouldn't know your fuel level. You wouldn't know if the engine is overheating. These reports are your financial dashboard. Alright, let's start with the big one, the profit and loss statement, or P&L. Some people call it the income statement. It doesn't matter what you call it. What matters is what it does. The P&L is your business's report card for a specific period of time, month, quarter, year. It measures one simple thing. Did you make money, or did you lose money? It starts with all the money that came in the door, revenue, sales, then it subtracts all the money that went out the door to make that happen. The first major deduction is the cost of goods sold, or COGS. If you sell t-shirts, blank shirts, the ink, and the labor to print them. When you subtract COGS from sales, you get your gross profit. That's how much you made before paying for everything else to run the business. Then come operating expenses, rent, marketing, salaries, electricity, everything you spent money on. Once you subtract operating expenses from gross profit, you're left with net profit. This is your bottom line. It's the final score. Was it positive? Congratulations, you had a profitable period. Was it negative? You had a loss, and you need to figure out why, fast. The P&L is a story of your performance over time. It helps you see trends. Are sales going up? Are certain expenses creeping higher and higher? This is the report you use to answer, how did we do? Reading a P&L is more than the final number. It's about relationships between the numbers. Look at your gross margin. That's gross profit divided by revenue. Is it healthy? Is it shrinking? If margins shrink, costs are rising faster than prices. That's a red flag. Watch operating expenses as a percentage of sales. If sales grow 10% but expenses grow 20%, you're heading in the wrong direction. The P&L gives you clarity to manage with intention. Now for the second crucial report, the balance sheet. If the P&L is a video of performance, the balance sheet is a photograph. It's a snapshot on a specific day. It tells you what you own and what you owe right now. It's built on a simple, unbreakable formula: assets, liabilities, equity. That equation must always balance. If it doesn't, something is wrong. Period. Assets are what the business owns. Cash, inventory, equipment, buildings, accounts receivable. Liabilities are what you owe. Loans, accounts payable, any other debt. Equity is what's left for owners. Investments, plus retained profits. So you know what these reports are. Now, how do you get them and use them? Good news, you don't need to be a math whiz with a green visor. Any decent accounting software, QuickBooks, Sage, does the heavy lifting. Go to Reports, select P&L or Balance Sheet and click Run. Boom, instant results. Customize by date, last month, last quarter, year to date. Compare periods to see growth and seasonality. Filter by department, location or project to see winners and losers. Filter by customer to find your most profitable clients. Customization turns generic data into decisions. Know what to look for. From the balance sheet, current ratio, 2 or more is generally healthy. From the P&L, net profit margin, how much you keep per dollar. Red flags, falling revenue, costs outpacing sales, shrinking cash, rising debt. High debt to equity means heavy borrowing. Risky. Use the trial balance as your error checker. If debits and credits don't match, fix it before trusting reports. Let's make this real. Imagine a small coffee shop. The owner, Sarah, is a student running it part-time. She pulls her P&L for the last quarter. Sales are steady, but net profit is down 20%. That's a red flag. She customizes the report to break down COGS. Her premium coffee beans shot up in price, crushing her gross margin. She checks the balance sheet. Cash is a little low, but her current ratio is a healthy 1.8. A small equipment loan, low debt to equity. The business is sound. This is profitability, not solvency. She calls her supplier to understand the increase, tests a quality local bean at better cost, and slightly raises prices on specialty lattes. She knows exactly which line hurt margins. So, she targets the fix. That's the power of understanding the numbers. Your turn. Open your software, run a P&L and a balance sheet for last quarter, calculate current ratio and net profit margin, find one odd line, and take one small step today.